I'm Brian Skinner with Skinner Wealth Strategies, and today we are tackling a huge question. The question is, are we at the end of the usefulness of the traditional 60-40 investment portfolio that's been the classic mix for retirees, designed to help them find the right allocation of balance, diversification, stability, as they're setting up their mix between stocks and bonds? The investing world has changed. The evidence is very clear. We want to talk about what are the reasons behind it and what are the implications moving forward. Let's start with the year 2022. This was a year in which stocks had a very difficult year, but it was also a year in which bonds had one of their worst years ever. Large cap US stock, or the S&P 500, was down roughly 18%. Long-term US treasuries dated 20, 25, 30 years, were down a staggering 31%. That's not diversification, that's double trouble. Here are the three main reasons that the 60-40 portfolio has broken down. Not the 60-40 mix overall, but the traditional version of 60-40. We're going to talk a lot about what makes up the 60 and what needs to make up the 40. The first reason that the traditional 60-40 mix has broken down is related to the 40% side, the bond side. Traditionally, that was made up of long-term US treasuries or the overall bond index, which has a lot of US treasury exposure there. When you go back through different market cycles, it has been proven that that type of bond allocation has actually cost 1.5% per year against performance. It didn't provide that balancing when equities were down. 2022 is a great example of that. Reason number two is that the diversification benefit of stocks and bonds is no longer as strong as it used to be. Traditionally, when stocks were going this way, bonds might be going this way, and that's why you own them, for that diversification benefit. That now dispersion or that correlation between them is much, much closer. Now, all too often, stocks and bonds are moving in the same direction at the same time, except that bonds haven't given you the total return that stocks have. Third reason is understanding history in the big picture. From 2009 through 2021, we were living in a 2% inflation world. From 2022 on, we are now have been living in a 3, 4, 5% or more inflationary world, and that looks likely to be what the decade ahead could be. Since 1900, there have been 6 different periods in which a traditional 60-40 portfolio produced negative real return. Real return is inflation adjusted, really the only number that matters. And what caused those negative real returns? It was typically wars, periods of high inflation or instability. We're not saying that that's the period that we're in today, but it's possible that we could be moving into that direction yet again. We'll talk more about the shift from the 2% inflation world to the 5% inflation world in future videos, but I want to highlight a few of those reasons for you right now. The first reason is record debt. Countries all over the world have taken out staggering amounts of debt to service their social pension schemes, their social contract in essence. And they're borrowing more money than they take in from revenue each year. That's inflationary. Reason number two is sticky wages and labor shortages. Gone are the times of mass migration and immigration that led to wages being relatively flat. With less of that happening in aging workforce, wages are on the move higher, which is generally good for workers, of course. But that labor shortage is considered to be inflationary. The third reason is resource scarcity. The sheer quantity of resources required to do things like the green energy transition or the artificial intelligence build out or building more nuclear to power that build out. All of those things require scarce resources. It's politically more difficult to get them out of the ground because they may be, environmentally toxic when refining these materials. Whatever the different reasons may be, it's just not that easy to get them, and resources are scarce. The fourth reason behind this shift to higher inflation is a general deglobalization. From the era of the Berlin Wall until COVID, supply chains were dispersing all around the world. There's something called comparative advantage, where countries or groups or states would do things that they were really, really good at, and other countries would do things that they were really good at, and they would share all of that, right? In Bangladesh, for instance, they're excellent at making clothing, right? And they do a lot of that there. We don't do that in America because we can't do it as well as they can for nearly the same level of cost that they can do it. So we buy it from them, right? But that era of globalization, while the overall global economy has grown as a result, it's been challenging for large groups of people who have lost out on that. And now the political tide has shifted against it, not just here, but really everywhere. And globalization is now kind of contracting more towards a reshoring where things are brought back inside the borders. The last reason is aging demographics, not just in our country, but all over the world, especially in the rich world countries who drive the majority of the economic growth around the world. China's population, for instance, is set to peak and start going down, if it hasn't yet already, within the next couple of years. The US has more and more people age 65 plus, making up a larger share of the population. As people age, they need more services from the government. Think about Medicare, Medicaid, Social Security. More people collecting it and collecting it for longer. Put these 5 things together, they equal higher inflation, higher interest rates, and most importantly, higher volatility. What are the consequences of this change out of the traditional 60-40 model as it relates to retirees today? First, let's start with the equity sleeve, that 60% sleeve. The first thing I think is important to point out is just from people living longer alone, the equity sleeve should be a higher allocation. It's not 70, doesn't have to be, but at least probably 65% to account for longer lifespans relative to when this baseline portfolio was established many decades ago. A huge topic of discussion in this equity sleeve right now is the magnitude of the concentration at the very, very top of the market. Just 9 companies in the United States make up well over 30% of the total value of all of the stocks in the S&P 500. As I'm recording this video today, one company, Nvidia, is worth over $4.5 trillion. It's worth more than all of the publicly traded stocks in the Japanese index put together. They're the 3rd largest economy in the world. It's worth more than all of the publicly traded stocks in France and Germany combined, right? It's kind of crazy how valuable these companies have become in America. They've had enormous profit growth. They've been amazing companies and amazing stories, but now the market is so heavily concentrated towards this narrow group of companies all in the same sector around technology that it opens it up to big risks if the market were to rebalance away from tech-led growth. One of the ways you can balance out this risk instead of just having naked exposure to it is by having a deeper focus on quality assets. Companies with low debt, strong free cash flow. Free cash flow is money left over after you've paid all of the expenses. It's not a statistic that you can really fiddle with or fudge. It's very clear. You want free cash flow, making a lot of profit. They can reinvest. They can buy back shares. They can pay out dividends. There's all sorts of ways in which they can return capital to shareholders or grow earnings. The next thing that we can do is add different company sizes. Smaller U.S. stock, for instance, is trading at close to a 30-year discount, even though it's historically outperformed large cap stocks. So the gap between where the biggest companies are trading from a valuation perspective and the smaller ones are trading is again at almost a 30-year widening. So those assets look attractive for long-term growth. Also, we want to have a focus on commodities, right? We talked about the shift to higher inflation means, or is partly driven by resource scarcity. You want to have exposure to commodities. In a higher inflationary world, commodities are able to price along with that and are oftentimes the cause of that inflation, or they can be, right? So having exposure to things like metals, industrial metals, gold, energy, agriculture products, commodities are a great hedge against inflation and have provided a diversification benefit that bonds haven't done nearly as well as we would have wanted them to. Now we get to the 40% allocation of the 60-40. Again, it's not that the 60-40 model itself is dead, it's that the traditional 60-40 model needs a rethink. In that classic version, which a lot of people are invested in through their 401k plan, their target date strategy, that 40% mix is made up by a total bond strategy, a bond index, or long-term U.S. treasuries. The total bond market, which is the classic index of bonds, has lost about a total of roughly 5% as I stand here today filming this video in total over the last 5 years. So it's made on average about negative 1% a year for 5 years. And this is making up for many retirees 40% of their retirement investment mix. That is not acceptable. That's acting like an anchor on your investments, we need to get more yield, more return than negative 1% from this asset base. The way we've been thinking about this, going back all the way to 2020 when interest rates were 0.5%, is focusing on something called prudent yield. Are you getting enough interest relative to the risk you're taking to get it? The classic bond market index has too much interest rate risk if interest rates go up, which causes the price of bonds to fall, and is not paying enough interest to compensate you for it. So how can we get a better balance of yield relative to the quality of the bonds themselves and how much interest rates exposure they have? So we look at things like bank loans, CLOs, mortgage-backed securities. These are all different industry type of words that I really don't like using, but bottom line is that there are different types of bonds out there. There's special little niche sections of bonds that make a lot more sense, at least in our view, relative to using the classic index as the only option inside the 40% allocation mix. One, we think it should be a little bit lower than 40% now, just as a factor of life expectancy going higher, but we also think you need to have an enormous rethink about what types of bonds are you using. What are the results of this type of bond investing? This type of approach would have yielded an 8.6% annualized return since 1987, with shallower drawdowns than classic bond indices have provided. In 2022 alone, when long-term bonds were down over 30%, U.S. Treasury bonds, this approach was down 3%. It makes a huge difference. The bottom line is that the traditional 60-40 mix did work in the past, but times have changed and you need to change along with it. Reimagining what constitutes your 60% in the equity bucket, probably a little bit more in equity. Diversification through focus on quality, focusing on different size styles, focusing on commodity exposure. And then also reimagining and rebuilding the 40% allocation piece in your bond mix. The traditional bond index is not the solution. Looking at other alternatives, the different types of bonds available that have maybe less interest rate risk and pay more interest than the traditional bonds have given a 60-40 portfolio. I'm Brian Skinner. Those are our thoughts about this controversial topic about is 60-40, at least in the traditional sense, still the right place for retirees to be in the decade ahead. Now, if you watch this video and you're sitting there wondering, is 60-40 right for me? Is that how I'm invested? Does it make sense for me to do something differently? Maybe it does. Maybe it doesn't. Don't guess. This is your retirement that we're talking about. It's a big deal. The stakes are high. What I want you to do is go to my website, book a 15-minute call with us. I'd be happy to talk to you about your concerns, what you're doing, where you're at, and point you in the right direction. I love doing those types of calls. Anything we can do to help, we'd be happy to do. If you found this content helpful, you found it informative, awesome. Subscribe to the YouTube channel, connect on LinkedIn. I'm going to be putting out more content just like this. If you have other questions that are a little bit deeper that I wasn't able to dive into in this video, or you have questions about how it pertains to you individually, awesome, totally okay. Go to the link on my website. There's a space where you can book some time with us. I'd be happy to talk to you about it. Help you as much as I can. It's complimentary. I'll point you in the right direction. If you have other questions, we can tackle those too. Thanks so much for joining us. Have a great day.